Today's episode is brought to you by Bit.com. You'll be hearing more about them later on in today's interview, which begins right now.
$60 trillion of debt has to be refinanced every year. And you need liquidity. In other words, you need balance sheet to be able to do that. And if that balance sheet capacity is shrinking because of the actions of central banks, we've got a problem.
Very excited to welcome Michael J. Howell, Managing Director of Cross Border Capital. Michael, welcome to Forward Guidance.
Good. Hi, Jack. Great to be here.
It is great to have you here, Michael, because you are the preeminent expert on a topic that everyone is talking about, but almost no one understands, and that is global liquidity. What is liquidity? What is the typical definition? And what is the sort of special definition that you attach to it at Cross Border?
If you think of it as a concept, it basically measures the ability to change your investment positions. Okay, so the ease of doing that. If there's lots of liquidity in a market, then you can change positions relatively easily. If there's a shortage of liquidity, it becomes very, very, very tough to change positions, to change asset holdings. Basically, more liquidity is good for risk asset prices. Less liquidity is bad for risk asset prices. Think of it in those very simple terms. If you put more liquidity into a financial system, what's happening is that you are decreasing systemic risks, okay? Because it's much easier for any particular entity to get funding. And if funding is that easy, people will, so to speak, move down along the risk curve into higher risk instruments. So in other words, they don't need so many safe assets or so much liquidity because there is already ample or excess around. So they will tend to spend that in asset markets first of all. Now you can drill further down and say, well, there are two concepts here. One is market liquidity, which is people often measure by the bid-ask spread or the depth of a market. In other words, how much you can transact at the prevailing price without essentially altering prices too much. That's one definition, a very standard definition of liquidity. The other definition, which is the one that we lean towards, is funding liquidity. And that is, is there enough cash or money, if you like, in the system to support your operations, your asset movements, what you want to do, can you get credit, etc. So it's the funding liquidity dimension that we put most emphasis on.
Explain, why is funding liquidity so important? How does liquidity rise? Who's responsible for it? And how does it fall?
Okay, it's important to say that those two concepts, funding and market liquidity, ultimately will move together, but funding liquidity will drive market liquidity. That's the way that we see it. In terms of what goes into funding liquidity, I think you can basically think of different actors in the system, in the financial system. You've got the central banks. The central banks are controlling a large part of liquidity through their monetary operations, what is now called QE or latterly QT, quantitative easing, quantitative tightening. Effectively, the Federal Reserve in the US will basically change the size of its balance sheet by purchasing assets, etc. So it might purchase from the open market, treasury notes, for example. It may actually give special purpose loans as another way of injecting liquidity. So that's number one. Number two is the banking system per se. I mean, think of high street banks giving out credit. So it's another form of liquidity that we monitor. Then you've got shadow banks, which are the more esoteric type of institutions, which basically operate, which are not formally banks or not regulated banks per se, but effectively they're doing banking type operations, and they may involve more exotic type instruments like repos, other money market instruments, etc. But they're forms of credit. Then you've got, on top of that, you've got corporations who basically build up large pools of cash. So think of Microsoft, think of Alphabet. These are the companies that basically have very, very large cash pools. And that's another form of source of liquidity. Then you've got cross-border investors. Cross-border investors are a source of liquidity if they're putting money into your asset market. Clearly, if the US investor is putting money internationally, that could be a drain of liquidity. So it's these various dimensions that we're monitoring, and we monitor that for now what is probably 90 economies worldwide. Basically, what we're asking is, where is the money in the world? Where is it traveling to? And that's the key to asset market movements. Let me stress that we're focusing here on the asset market, the financial money. We're less interested in money that goes into the real economy, although clearly real economy economists will focus on that rather more than we do. We're thinking of the asset market implications. So we're looking at how that money travels around the financial markets into asset prices. So basically, it's all about saying, is there plentiful liquidity or is there deficient liquidity? And that is really feeding the normal funding requirements of an economy.
And what are the implications of liquidity on asset markets if the past 2 years was a great time to short volatility, a great time to short bonds, a great time to own risky cyclical stocks and stocks of all flavors? What might the next 6 to 12 months portend if, as you write, 95% of all central banks are withdrawing liquidity?
Yeah, I think this is the equation has changed very, very quickly. As you rightly say, 95% of the world's central banks are now tightening monetary policy. This is a big number. It's very, very rare we see anything like that consensus towards tightening. Now, the point about withdrawing liquidity is that that's clearly going to be a big negative because it will raise systemic risks. It will mean people have less ability to get liquidity or credit or use savings and transactions. The Federal Reserve is slated to reduce the size of its balance sheet by about 2 trillion. That's what the numbers say. The reduction in the effective balance sheet, in other words, how much money actually goes into the market, will be smaller than that headline number. We may be down, 1.5 trillion or whatever. And that probably means, in terms of effective money injections by the Fed, a 20% drop over 2 years. Now, given the fact that the equivalent rise led to, what was it, a 30% jump in the S&P, we could be looking at something similar. As a heads up, a normal monetary tightening, not of this scale, but a normal monetary tightening, cyclical one, would normally lead the S&P down by about 15%, so a 15% correction. If you get a recession thrown in on top, you're talking of a 30% reduction in the market. And if you get a banking crisis on top of that, you're talking about 50% down. I don't think we're going to get the third. I think we're getting more than the first. So I'm plumbing for the middle, which is about a 30% correction from peak to low. And I think we've had 10% of that already in my estimation. So we probably got a 20% drop already coming ahead of us. And the point to remember about the financial system is that, contrary to what the economics profession says and the economics textbooks spell out, the financial system is much less a new financing system than it is in reality a refinancing system. In other words, with a lot of debt out there, we've got $300 trillion worth of debt in the world economy. If you think that the average life of that debt, the average maturity, is around 5 years, that's saying that $60 trillion of debt has to be refinanced every year. And you need liquidity. In other words, you need balance sheet to be able to do that. And if that balance sheet capacity is shrinking because of the actions of central banks, we've got a problem.
And how does that problem manifest itself in risk assets? You have a view about volatility, stocks, bonds, and commodities too, I think. What is that?
Well, I think the first thing to say is that as the Federal Reserve balance sheet shrinks, so the balance sheet of the broader financial system will shrink sort of pari passu, at least with that Fed contraction. On top of that, what you would say is that the decline in liquidity will raise market volatility. Okay, we've seen huge volatility already in the last few weeks in the Forex markets with the collapse of the yen. We've seen it in the US fixed income markets with soaring treasury bond yields. We've seen it in commodity prices with spiking oil prices, etc., food prices up. What that means, that increase in volatility, is that it becomes a lot more difficult for people to borrow against that collateral. Because the collateral is being volatile, you need more margin. The lenders will say, we're uncertain, the uncertainty has increased, therefore we want more margin against the loan. So there'll be bigger cash demands to get a loan. In other words, bottom line is volatility means a shrinking pool of liquidity in the system. So on the one hand, the Fed is tightening. On the other hand, you've got collateral being hit by higher volatility, and that means that liquidity generally is contracting from these two sources: the private sector and the government.
Michael, you've got a chart of your global liquidity index, and we are coming down from a near record high, and I believe we're at something like 58. The index goes from 0 to 100.
Correct.
What stage of the liquidity cycle and the economic cycle, which are two cycles you follow as well as their interplay, does a 58 indicate if it's coming down from a high? At what point in the cycle are we?
Well, we think we're on the verge of what we would colorfully call the turbulence investment zone. In the turbulence investment zone, what you basically begin to see are things like flattening yield curves, a very steep front end to the yield curve or the term structure, which we've got right now, increased bond volatility, we've got that, tick all these boxes. You'd expect to see outperformance from defensive growth names like brands or utilities within the stock markets. That's happening. The stock market increasingly coming under pressure. Volatility-based strategies, in other words, making money out of volatility, should begin to increase significantly. You want to hold the dollar as in your cash. In other words, cash should be in dollars, not other currencies. All these features are what we're currently looking at. So in our view, the cycle is not distorted as many people claim. It's not unfathomable. It actually is a relatively normal cycle. The central banks plowed liquidity in, asset markets zoomed, as you would expect. They're pulling the rug away now, and asset markets are adjusting downwards. It's not a straight line adjustment, but just think in bear markets, there are very, very vicious rallies you get when stock prices suddenly soar for a few days or maybe a week or so, but then they resume their downtrends. Okay, so what we're looking at is an orange-yellow line, which is the liquidity cycle, the notional liquidity cycle. It's a cycle, so it looks like a sine wave as we've drawn it. And then behind that, as it shows about 20 months later, is a red line, which is referring to the economic cycle, the business cycle, if you like. And the business cycle tends to be very closely aligned with the risk appetite of investors. So in a boom, investors are more likely to take on risk, and in a recession, they're less likely to take on risk. They want safety. Now, the 20-month displacement of the economic cycle is the normal lead time that liquidity precedes business activity. It's actually, to be strict rather than, or to be less precise, it's a range of around about 15 to 20 months is the normal sort of lead time here. Now, we think of the liquidity cycle as moving through four very distinct phases. Calm, as the name suggests, that's the, if you like, the first phase of the cycle when liquidity is above average and rising. Then you get speculation, which is a later stage cycle when liquidity is above average but falling. And next one up is turbulence, which, as the name suggests, is one where volatility becomes more of a problem. That's liquidity below average and falling. And then finally, you get a rebound move, which is a beginning of a new cycle. And that is when liquidity is below average but rising. So where are we now? We are very much at in the turbulence zone, according to what we see, or just about to enter the turbulence zone. And that's what the fixed income markets are telling us very clearly.
And has the yield curve turning point in red, has that already occurred? And has the risk appetite turning point in brown, has that already occurred?
Yeah, the red dot that you see is the peak in the yield curve. The first dot. The second red dot is the trough in the yield curve. So the yield curve tends to move about 8 months behind, 7 to 8 months behind the liquidity cycle. And then the risk appetite cycle moves largely coincident with the real economy. In actual fact, it probably proceeds by about 3 months or thereabouts. And that, if you do the sort of the arithmetic here, then you're really saying that the stock market, the yield curve probably precedes the risk appetite of investors by around about from the peak of the yield curve, you're talking about maybe 12, 15 months. And then if you look at the yield curve on the economy, that's something like 9 months or thereabouts. So those are the sort of derivative lead times you'd expect. Now, what we therefore are anticipating is this move into turbulence is telling us the economy is peaked and starting to slow down. Now, the next slide that you can go to, which is looking at a stylized fixed income allocation, is to take that same diagram, the same cycle diagram, and basically annotate it with different points, which we take from the left-hand side of the slide, which is a phase diagram showing what you'd expect to see in each phase. And basically, if you're in the turbulence zone, or let's say between speculation and turbulence, which is the area that we label D, what you'd expect to see is a convex yield curve, tick that box. You'd expect to see a flattening yield curve, tick that box. And you expect to see increasing market risk, we'd tick that box. We've increased volatility, in other words, tick that box. So all those things are sort of falling into line. And then the next phase up, which is moving to phase A when the cycle begins to pick up, when you're really at that low point of the liquidity cycle, that's when you basically that's when you would see peak credit risk. Now we're not there yet. Credit risk is peaking at that point. So at the trough of the recession, or trough of the liquidity cycle, just ahead of recession, you're seeing credit risk basically high.
And Michael, I think you have a great chart showing that on full display, where you take the average liquidity index cycle and you see when the S&P 500 bottomed. So when the S&P 500 tends to bottom at the absolute bottom of the cycle for the S&P 500, the US liquidity is actually at its top, is at its maximum level.
Yeah.
How is that the case? That seems a little paradoxical on the first
Well,
look.
it's basically because the Federal Reserve is trying to save the system and it's plowing in huge amounts of liquidity. Corporations are probably trying to generate as much cash flow as they can at that stage to try and work through financial problems. And the old saying is the Federal Reserve tightens until something breaks. Well, once it's broken, they try and fix it again. So they're pouring more liquidity in. But this data, when we say it's an average cycle, this is using data starting from 1970 all the way through to the current period. And it's averaging each cycle. So in other words, that yellow dotted line for the S&P is an indexed S&P, a standardized cycle on average over each of the cycles in that window, 50-year window. And the same for the liquidity cycle. That's the average cycle that we've got from our data, shown as an index of liquidity. So liquidity will trough around about 10 months before the trough in the S&P, and it will basically, it will peak pretty much coincident with the low point of the S&P. And you can see in terms of the lead time coming into the cycle, the liquidity begins to turn down again about sort of 9 to 10 months before the market starts to feel headwinds.
So the x-axis on this chart is months from the S&P 500 low. So it will be 0 for the absolute low. And I noticed that at the minus 20 mark, that's about where the global liquidity index goes down from a high to about a 58. And I know we're at 58 now. And then I look at the dotted yellow line of the S&P 500 and you start to see some volatility, but not a huge drawdown yet. Do you think that, if this model holds, are we at that point where we are roughly 20 months from a S&P 500 low?
Maybe things are happening faster right now. I mean, I think the reason for saying that is that the question to pose is, can the Federal Reserve afford in this current environment to break the market, break the economy? And when we've got two battles out there, one a geopolitical battle and the other a battle about domestic inflation. And clearly those are really, there's a tension between the two of them. So I think that the authorities will want to tread relatively carefully about how much they want to tighten. Ultimately, I'm not saying that they're going to slow the tightening down in the near term, because I think they're still going to go ahead with aggressive rate hikes because they want to try and break the back of inflation. Inflation in the West is clearly a major issue for politicians. I mean, that much is clear. Looking at consumer surveys, this is a big issue. Politicians will have to face that. Midterm elections in the US, clearly that's going to come to the fore. It's already a major issue in France, where they're going through presidential elections at the moment. It's one of the big talking points. So this is in play. So my estimation will be that the Federal Reserve continues to tighten, things break, and then there is probably a reflection about how much they can afford to let economies weaken. Because in our view, I mean, the economy is leveraged to liquidity. The markets are leveraged to liquidity. So once this thing starts to break, it will hit the rocks quite quickly, and then we'll see the Federal Reserve coming back in my view, with some alacrity.
Michael, you said the Federal Reserve is going to keep tightening until something breaks. What do you think is going to be the financial instrument asset class that breaks? I was speaking to a very smart person in the monetary plumbing world who recently said that it won't be the repo system like it was in 2018 that broke, because the Federal Reserve now has this standing facility. They have more control over it. Do you agree with that? And if so, do you think it's some other area, maybe that the banks in the private bank balance sheet, the lending standards, the credit spreads that you see the stress?
Yeah, it could well be. I mean, I think it's impossible to say that you won't get a repo problem. I think it's unlikely. I think that your contact was probably right on there. But let's not rule it out. Anything's possible if you get sufficient stress. I would tend to think it was more likely to be the corporate credit market in some guise. And you got to extend that out into private equity. Private equity has been a booming market, but private equity needs funding too. So these could be areas that come up, and that's what I would be looking for. I mean, look very closely at what's happening to corporate spreads. Corporate spreads normally follow an inverted yield curve. So if you think there's value in the yield curve, just flip the yield curve upside down and look how it traces out the forward pattern, the forward path for credit spreads. You can see here what that basically shows is the 10-2 yield curve. Although I said, don't use it as a predictor for the economy, it works pretty well here in the context of the credit market. And what it's showing is a normalized index of US credit spreads in terms of the yield spread. So what that is, how we do that is just look at a whole series of different quality spreads. So it could be the junk spread, triple C minus single B. It could be a high yield spread, say single B versus triple A. It could be the quality spread, BAA versus triple A. All these different spreads are thrown in. They're indexed, and we just create an aggregate to show the normalized movement across the spectrum of credit quality. And what that's showing is a very clear cyclical pattern that seems to move pretty much about 9 months behind, in this case, the movement in the yield curve.
And Michael, it appears to me that the credit cycle in black often is above the yield curve at a certain point in time.
Yeah.
So the fact that the yield curve is essentially inverted, or has been inverted over the past month, going in and out of inversion, and credit spreads are still so wide, what does that signal to you? And I could also ask you the same about the equity market, where equity risk premia are still quite tight, and high yield credit spreads are almost, within 100 basis points of record tights. What does that mean to you?
Yeah, well, I think that investors are taking on too much risk right now. That's for sure. But I think if you look within the market, you can see there's a lot more sense. And I think it was Stanley Druckenmiller who said that the real truth in the equity market is looking at sector movements, not the overall index. The question to ask is what is outperforming at the moment, and it's things like utilities or brand names, which are basically seeing a relative outperformance, not some of the cyclical or technology names. That's leading up to recession or slower growth. That's what it's discounting. The message is the same from the yield curve. If you take the yield curve, but my view is the yield curve plus the measure of convexity is a nailed-on, certain view of whether we get a recession or not. I think that's highly likely now. And you've got the stock market, which is telling you in terms of sectoral movements that investors want safety. And that's the message coming out of the fixed income markets too.
A component of fixed income is real yield, but then there's also the inflation expectations. The globe has been rocked by high inflation prints over the past year that don't seem to ever fall. How have you made sense of the bond market's reaction where inflation expectations have risen? And then also tell us a little bit about the work you've done on the ability of pass-through inflation for inflation to beget inflation in the next month.
Yeah, I think one of the things to remember here is that, and maybe looking at this data, what we've been experiencing in the last few months in the US or Europe is no great surprise. What that basically is telling us is that the pass-through of an inflation shock to the next month or from month to month is actually very elevated. Now, if you put that in sort of quantitative terms, what we show is that currently, if you get 100 basis point shock to CPI inflation, consumer prices, let's say in the month of April, you will get 72 basis points, in other words, 0.72%, transmitted in the month of May from that 1% shock. There'd be a carryover effect. And then if you carry over another month, you get 0.72 times 0.72, approximately 0.5, 50 basis points or 0.5% in the June number. So you've got this sort of long tail of persistence of inflation. And that's what inflation expectations are, that's how they're operating now. So if you add all that up or look at the implications, it's saying that the inflation shock will last about 2.5 years right now, compared to maybe 3 years ago when an inflation shock lasted 2 to 3 months. That's a dimensional difference. And that's what the Federal Reserve needs to crack. And therefore, in our view, you've got probably a bulge in inflation that may last 2 to 3 years. That's what we're facing. But longer term, there is good news because deflation or disinflation, in our view, is coming back. And that, as we'll articulate, is a demographic story more than anything else.
How are you weighing the risk reward of long-term government bonds? They've seen a huge sell-off, but do you think that we're approaching a ceiling in yields for them? And then how are those bonds reacting to inflation expectations if inflation is going to be elevated for at least 2 years?
The first thing to say is that if you look at the fixed income markets, when I used to work for the US investment bank Salomon Brothers, the saying in the fixed income markets was, it was called 6 of 50. And that is to say that there has never been a 6-month period in the US markets where the yield on a long bond has moved by less than 50 basis points in either direction. Okay. Now, that's a rule. It's precisely wrong, but it's approximately right. So it works about 60% of the time, which is not a bad, not bad for a rule like that. So what that tells you is actually the fixed income markets are far less investment markets than they are sort of speculation or trading markets. And that's sort of the surprise for many investors. In reality, there's a lot of movement in these markets. And what it's saying is that if you get a sharp upward move in yields over a 6-month period, hey, we've got that. You're going to get an equal move in yields in the next 6 months, probably downwards, right? And that's what I'd be betting on. Now, the other reason is that, hey, look at the economic data. It looks pretty soft. You've got nowcasting estimates in the US from, various feds, the New York Fed or whatever, saying that the economy is softening and they're reducing their expectations. If there is a risk of recession, and that's what the yield curve is telling us, why shouldn't you own bonds? bonds have got to be a great investment in this environment. But I can't think of any major institution, either in the US or internationally, which is overweight fixed income right now, particularly longer maturity fixed income. So I think this makes sense unless we're moving back to a world of stagflation, which I don't believe.
Michael, looking at your many year chart of the global liquidity index and you price it against global wealth, you price it against the stock market, it's startling how there seem to be so few examples when the model doesn't apply. Do you think that this global liquidity cycle, where it's roughly 65 months, do you think it sort of always applies? And if the view that you stated about you think stocks will go down and that bonds will do well, volatility will be elevated, like let's say in a year from now, it sounds like there's a low probability according to you. What if stocks are higher and credit spreads are even tighter and the dollar is very low? Like, what can you think of a reason as to why the global liquidity index would have indicated otherwise?
Well, I think it comes back to sort of to simple math. I think is that you've got there are two factors that, in our view, drive. Let's think of stock markets. Okay, one is liquidity. And one is the risk exposure of that liquidity, okay? So think of the analogy. Let me take an analogy. Think of earnings and a PE multiple. So if you've got earnings falling and you want the stock market to go up, you're going to have a big jump in the PE multiple to actually do that. So let's think of the equivalent analysis for liquidity, okay? Call that L, not E, L. And think of the amount of equities or risk assets divided by that L as a ratio, which reflects, if you like, portfolio allocation. So it's the amount of equities that will be supported by that pool of liquidity. So to get the equity market to go up, you've either got to have the L going up or you've got to have that ratio increasing. And that ratio reflects risk appetite. It's the risk positioning of investors. If liquidity is not the driver, then it's got to be increased risk taking by US investors or any investors. And is that likely in an environment where you've got an economy which is sagging or looking weaker? And I think it's unlikely.
Today's episode is brought to you by Bit.com, a leading cryptocurrency trading platform. From spot to futures to options trading and more, Bit.com has it all. So whether you're a seasoned investor or you're new to the game, you need to be on Bit.com. Bit.com has launched a zero taker fee option campaign until May 10th. To enroll, email VIP@bit.com. That's bit spelled B-I-T. So email VIP@bit.com and tell them I sent you.
What do you make of the rapid rise of front-dated yields? It's my expectation that because the Federal Reserve is, as so many say, behind the curve, and as you write, more behind the curve than other central banks, so they have to tighten more dramatically, we've had a huge surge in short-dated yields. So there was a time when the 2-year yield was 40 basis points, and now it's 200 basis points higher than that. Does that stand out to you, or is that more typical than I would think?
Yeah, I think that, to answer your points, the first thing to say is, where is the Federal Reserve now? Why has it been slow to catch up with other central banks? Why have they led? I think it really comes back to two things. One is there was a great reluctance in the Federal Reserve to actually tackle the emerging inflation problem. And you can see that in their choice of words, transitory. If the central banker uses the word transitory, it tells you they don't want to tighten, okay? The second thing is that what you've got as well is you had the Treasury debt ceiling late last year, and what that meant was that there was this is a wonkish interpretation, but the Treasury General Account, which is the U.S. government's account at the Federal Reserve, was run down because of the ceiling on debt issuance, and what that did was to inject liquidity into the money markets. So if you look at the pattern of Federal Reserve liquidity injections, they began to roll over maybe as early as summer last year, and then there was a spike upwards as this Treasury General Account was run down, and now they're resuming their downward course. But in that window, other central banks were tightening more aggressively and more consistently, and hence the 95% number that you cited earlier on. Okay, so that's that part. The other part is to say, what is the yield curve telling us? Bond markets never lie. Bond markets are in many ways the truth out there. And I think one's got to pay attention to what the bond markets are really saying. Now, our interpretation has always been the yield curve as people cite it, which is normally the spread between the 10-year US Treasury note and the 2-year note. That's the typical yield curve definition. That's not a particularly robust predictor of the economy. It works sometimes, but if you look at the history, what you find is that different maturity spreads work at different times better than others. Okay. Now, what that is really telling you in, again, wonkish speak, is that convexity, the curvature of the term structure of interest rates, matters a lot. And so what we do is to treat the yield curve in two halves. Okay. The first half is the forward maturities. In other words, or the near-term maturities. Those are maturities up to, say, about 5 years. So from anything from 3 months up to 5 years. What's going on at the moment is those spreads are widening very sharply as the Federal Reserve announces its intentions through forward guidance to raise rates aggressively. And we heard James Bullard a few days ago saying, he wouldn't be adverse to maybe 75 basis points at the next FOMC meeting. But it looks as if 50 basis points is now becoming the consensus for the next rise in Fed funds. Okay, so what you've got is a steepening front end of the curve. Now, that is causing a pain, or will cause more pain for corporates, because corporates basically refinance their debt in this 3 to 5 year window. So it's immediately having an impact on the cost of capital for many US businesses. The second thing that's happening is the back end of the curve. The back end of the curve is flattening aggressively, okay? And the speed of flattening has caught many people by surprise, but it's happening, it's being disguised because what you're getting is actually a bearish flattening at the back end of the curve. So in other words, 10-year yields are rising, but they're still rising less than the 5-year note is. And that's the key point here. So what that's telling you, again, this is sounding wonkish, but hey, this is bond maths coming out, so yeah. You'll apologize, is the term premia in the bond market is collapsing, particularly at those longer end maturities. Now, what is the term premia? Think of it as just a measure. I mean, it means a lot of things, but for these purposes, think of it as a measure of the excess demand or excess supply of bonds at different tenors. So if you've got a very small term premia, or a negative term premia as we've got now on our estimates, what that's telling you is there's huge excess demand for longer dated bonds. If there was a positive term premia, it would be telling you there was excess supply of those bonds. So that's basically the reality. And what we're seeing now is this flattening is a measure of the extreme excess demand for safe asset treasuries. Typically, US institutional investors and global investors believe that if there is a recession or there are financial problems, the 10-year note will likely outperform, or longer duration bonds, but the 10-year note in this case, will outperform shorter maturities significantly. So there's a great gravitation in the market towards this 10-year safe asset. Now, add that to the story of the front end, and you can see from a corporate's point of view, this is not a very happy situation. Not only is the cost of financing going up, but the appetite of investors for anything risky is diminishing rapidly. And that's the story in the bond market. So the yield curve is a great predictor of the economy when it combines with what is termed convexity. In other words, a bulge or a fat belly on the curve.
So the term premium is collapsing. People want a lot of safety, But that's only on a relative sense, right? In nominal terms, we all know the 10-year yield, the 30-year yield, they have been rising as well, just not as dramatically as the front end. And I think you're seeing something of a historic route in particularly the long end of the Treasury curve. So what does it mean when long-term Treasuries sell off so much, and yet the yield curve still flattens and still has that bump in the belly? Does that indicate just the rapidity of the short-term yield, that rise, or is it something more sinister?
Exactly. No, I don't think it's necessarily anything more sinister. It's straightforward as far as we see it. The whole curve has been lifted up by short rate expectations rising, policy rate expectations rising. The whole level has risen, but the curve basically has flattened more at the back end than the front end. So you're getting a slight inversion across the term structure. Now, the worst possible term structure is one where you've got essentially a flat to slightly downward sloping curve, slightly inverted curve, but or certainly downward sloping curve, but with a big belly around the mid-duration tenors. And that's exactly what we've got right now. So it's not necessarily an inverted curve that really worries people. It's actually that configuration that I've just described. Now, and by the way, if anyone's interested, we go through this. If anyone's wonkish enough to like fixed income maths, there's a paper that I authored a few years ago in the Journal of Fixed Income, which explains all this stuff. So, if you want to put a wet towel around your head and go through it, be my guest. But that's basically the bond math story. Basically, what you want is two spreads. You want to measure the risk appetite of the market, which is basically a longer dated spread, like a 10-5 is good, right? That's a pretty decent spread to look at. And the other thing is you want to gauge policy expectations, which is a front-end spread, which could be a 1 year, 3 year, or 1 year, 5 year. 1 year, 3 year is pretty good. So if I had to choose two on my desert island, it would be 1-3 and 5-10.
Okay, thanks for that. And that 1-3 spread, the front end of the yield curve, it indicates that the terminal rate for the Fed funds rate is something about 3.2%. So that's 12 hikes and then some.
Yeah.
Do you think that's possible? And why or why not?
No, I don't think it is possible. And I don't think it's possible because the whole financial system is a lot more fragile than people or than policymakers think. And the reason for that is, well, there's a whole host of reasons, but the paramount reason is there is so much debt out there. And the question is that can the monetary authority tighten without disturbing this whole refinancing mechanism? And what I've said is that the issue that we face in Western financial markets is that the financial system is a refinancing mechanism, not a new financing mechanism. There's not that many new corporations, wanting to raise money for new capex investment. There's not that amount of new capex going on. We know that. Okay, that's just one of the symptoms of of the current economic situation. We've had that for a decade or more of low capex. Okay, that will likely persist. There may be blips, but the trend is low. But with all this debt out there, financial markets are basically rolling over debt. And that's really the issue. It's a refinancing mechanism. So basically, if you disrupt that refinancing mechanism, what do you get? You get essentially a liquidity stroke financial crisis. Now, how many of those have we had over the past decade or 2 decades? Quite a few, I would suggest. Okay. Refinancing and funding is really what this financial system is about, and it's understanding, as people sometimes call it, the pipework of the financial system.
Michael, there are a lot of analysts out there who would say, yes, Michael, almost every central bank is withdrawing liquidity. Yes, the economy is slowing. Yes, the bond market is flashing a red warning sign. However, Michael, don't you know the People's Bank of China is here? They are going to save things. They are going to inject liquidity, boost demand for commodities, and essentially heal the entire global economy. Why are they wrong, Michael?
Well, just look at the evidence, okay? The evidence is that probably every month for the last 5 years, there's been an analyst somewhere, or several analysts, saying the People's Bank of China is about to ease. It's easing, okay? There's no evidence at all they've been easy whatsoever. The balance sheet of the People's Bank of China has flatlined pretty much since 2017. There's been virtually no growth, okay? Contrast that with what the Federal Reserve and the European Central Bank have done, where they've ballooned their balance sheets, okay? And the Bank of Japan, for that matter. But the People's Bank of China has flatlined things. Now, that's been recently articulated by a series of speeches by Chinese policymakers to say that what they're really leaning to now is stability. They don't want growth at all costs, that's dangerous, but they want stability. Now, if you look at what is driving policy in China, it seems to be that stability is stability of the yuan or renminbi exchange rate, okay? So look at, and we track this daily, but look at interventions by the People's Bank of China, their liquidity injections into markets. It's all governed by whether the premium on the offshore yuan, the Chinese currency, is basically positive or negative. And they will essentially move liquidity injections to basically keep in line, to keep the yuan stable. And the yuan has been pretty stable, one would have to say, or even firm to strong over the last 12, 18 months. Now, that may be changing, and I say maybe, and it may be, although this could be a Machiavellian comment, that maybe there is some move out there to try and put pressure on the Chinese authorities. And look at what's happened to the yen exchange rate. Now, the Chinese are very conscious, as are the Japanese, of the Chinese yuan, Japanese yen exchange rate. Clearly, that's very important. It's the key axis in Asia. Two big economies, two very closely integrated economies now, that exchange rate matters. So if you see disruption like you've seen in the yen-yuan rate, that could mean serious trouble for one or other of the economies. It's putting pressure at the moment on China. So the Chinese economy is slowing because of COVID-19 lockdown. It's slowing because there's been no great liquidity impulse, but it may also have to wrestle with this problem of a much firmer yuan versus the Japanese yen. And that may be an attempt to try and put pressure on the Chinese economy. That may sound Machiavellian, but hey, these things have happened in the past. Don't rule that out. On the other hand, you could come up with good reasons why the yen has weakened, simply because Japanese monetary policy is much weaker at the moment than the Fed's intentions.
Right, and that policy is the Bank of Japan will not allow yields on Japanese government bonds to rise. Therefore, their bonds are relatively unattractive. So people buy, let's say, European bonds or
Correct.
US bonds, and that causes the dollar to rise. But the dollar has risen so dramatically. I believe the DXY is US dollar index is now at 101.
Yeah.
I'm sure a lot of that has to do with Russia's invasion of Ukraine, but how much of it has to do with the forthcoming withdrawal of liquidity that we've already seen? The fact that the liquidity index went from somewhere in the 80s to 58. I just recall from memory that the tapering of 2014 saw a dramatic rise in the dollar as well. It doesn't seem like they'd be connected, but why is it that if the Fed pumps on the brakes, suddenly the dollar explodes higher?
Well, you're just reducing supply of dollars in the system. That's the reality. But I think it's very important to stress that, where the Federal Reserve has come from in this picture. If you go back to 2008, in many cases, it was reasonable to suggest that the Federal Reserve had lost control of the credit system. And you had a lot of shadow banks, overseas banks, basically controlling dollar supply directly or indirectly. And the Federal Reserve had almost taken a back seat on that, had been eclipsed. Now, what the Federal Reserve has done in the last decade or so is muscle forward and actually get to grips again with dollar supply, control of the dollar markets. And it's done that through whether it be regulatory change, whether it through factors such as tax changes on US banks about forcing them to repatriate money back into the US, whether it's occurred through the swap lines that the Federal Reserve has enacted. And these are very pointed swap lines. They clearly demarcate friend from foe in terms of allies of America. And the Federal Reserve is now very much in the driving seat. Federal Reserve controls liquidity to a much greater extent than it did in 2008, for example. On our back of the envelope estimates, we'd say that the Federal Reserve's control has probably gone up threefold since 2008. That's a market change. Now, if the Federal Reserve is crimping supply of dollars, then you're going to expect the dollar to go up. But hey, there's another factor, which is safe asset demand. And in an environment where you've got geopolitical problems, people are going to start to gravitate towards the US dollar. And that, I think, is clearly happening in this case. One thing I'd also throw into your point about the yen is that the yen carry trade was probably an important source of funds flow into America. And that is Japanese institutions effectively using yen to borrow dollars, yen collateral to borrow dollars. If you've got volatility in the yen market, going back to my earlier comment about collateral and the value of collateral in a volatile environment, that credit source dries up or slows down significantly. So in other words, the volatility we've seen in the yen over the last few weeks is going to diminish flows of money into the US from Japan by definition.
Yes, you're right about how huge price shocks in oil destroy liquidity as well. I can relate to that because when the volatility of collateral goes up and down more, banks have to assign more margin to it, so it takes up a bigger percentage of the balance sheet. Can you explain the significance of that, and specifically why surging oil prices are going to drain liquidity even more than already you had anticipated?
Well, I think you've got a number of reasons why the oil market matters, not least its absolute size. The first thing is that higher oil prices clearly cause people to, or force people to spend more money in the real economy. And if you're spending more money in the real economy to fill up your gas tank, there's less to put into financial assets by definition. Second reason may well be the Fed itself is spooked by higher oil prices and will actually think maybe we need to tighten even more to contain inflation. Third reason is the one you cite, is that from a lender's perspective, if you've got high volatility in the commodity markets, they're going to demand more margin, which will make lending or borrowing rather less attractive. And institutions will borrow less, therefore they'll have less funds to put into financial markets, etc. So you've got two sides, demand and supply, which are basically causing liquidity to shrink.
Michael, now I want to step away from the here and now and take it back over the past, explore some longer dated themes over the past of your career. So, I think of you, Michael, as sort of the godfather of global liquidity, because before the work that you did at Salomon Brothers, and I want to hear about your career, there wasn't really a sense of global liquidity. And in some ways, there didn't need to be, because the market has changed so much. So I want to hear, what was it that you started observing at the 1980s that say, this thing called liquidity, it's so important to track? And then how did that evolve over time as repo emerged, as the shadow banks became larger? What sort of secular trends did you observe in the funding market, the wholesale funding markets that you noticed? And then can you also talk about the role of the dollar over the past 40 years?
Okay, yeah. There's a lot to cover. I think the first thing is to say, what changed in the international markets in the 1980s, and that was basically that what you saw was deregulation, and that was basically kicked off in many ways by the British government under Margaret Thatcher taking away exchange controls, and a lot of these moves were encouraged by the US as well. The US followed. Japan started to reduce or take off its exchange controls or capital controls in the early 80s as well. So there's a lot of money that was invested domestically in these major economies that needed to diversify for prudent reasons. And so it unleashed capital flows. And so what you saw, and this was really a carryover from the 1970s as well, where you basically had seen bank capital become very free. The growth of the euro-dollar markets meant that bank capital flows were important. And now what we were getting in the 1980s were security flows were basically moving around as well. So the whole capital account was being freed up, if you like, and that capital account moved very aggressively and very quickly. And that was the big change. So, one of the things that we often say is that as the world has got bigger, it's become more volatile, and that's one of the realities out there. And that's one of the theme of a book I wrote a couple of years ago called Capital Wars. So that's just looking at this particular phenomenon. Now, the second thing you say is that what's changed in the landscape generally in financial markets. I think one thing is the internationalization. So we live in a global world, and that's clearly critical. And we need to understand what the Chinese are doing. We need to understand, certainly we had to understand in the 1980s what the Japanese were doing. We sometimes have to pay attention to what's happening in Europe as well, believe me. That's also important from time to time. And clearly the US matters hugely, okay? So all these factors need to be brought into the equation. But I think that almost the overriding difference in financial markets between when I started my career and now is the growth of wealth managers, small wealth managers in almost every town. I'm sure you go across the States, look at the number of wealth managers you get. You didn't see that, 30, 40 years ago. This is a new phenomenon. And it's saying that as maybe people move towards retirement, they build up their 401ks, they need advice on where they put money, they need to plan for retirement, all these things. These are big, big pools of savings, and those savings have to go somewhere. Now, that particular comment, which is explaining why asset markets have become so big, and you can also extend it to say, well, what about the role of the dollar? Why is the dollar so important? Well, think about this from the perspective. I mean, a lot of people, look at the dollar question from a trade accounts. They talk about trade wars or whatever. I mean, this just doesn't apply. This is not the big issue. The big issue is capital wars, and it's about basically controlling the funding or investment landscape in the world. Now, if you're China, or let's even say Russia, because Russia's got a big trade surplus now, thanks to higher oil and gas prices. Ever since the invasion of Ukraine. Where do they put that money? They've got to put it somewhere. Where's that trade surplus go? It needs an asset market to go into. And if you look at the US trade or current account deficit, which a lot of politicians, a lot of well-meaning academics say, well, this is all about poor competitiveness of US industry. Actually, no, it's about the super competitiveness of the US financial system. That's what it's about, because the capital and current accounts have to balance. They've got to offset each other. So if the US has got a big capital account surplus, which it has, you've got to have a trade deficit as the result of that. That's just maths, okay? And the point to think about in this whole equation is, and that's why, I think talk of Bretton Woods 3 may be well-meaning, but I think is wrong, is that, commodity standards have never worked in the past. And Bretton Woods 3 is the idea that, Russia or China or whatever can basically create a funding system based around commodities, or a currency system based around commodities. That's never worked historically. Gold is not a great vehicle to use as a benchmark, an anchor for currencies. I mean, that's what we've learned historically. That's not to say gold is a bad asset necessarily, but it's not what you want for a currency system. And basically, what you need is something which has got some elasticity in it, because effectively the world economy has got to grow. And what we've lent on for much of the last 40 years is basically the US dollar, and particularly the US Treasury bond. And the whole point about this is that, what that system exists as is a funding investment system, not an accounting system for trade, which is how the majority of people see it. They see it as the latter. It's actually much more the former. And that is why the dollar is going to outlast any of these negative predictions, because basically it's going to be really difficult for anybody to displace that funding mechanism. Part of it's grown up by US expertise. Part of it's accidental with the growth of the euro-dollar markets in the 1960s and 70s. But hey, that's what we've got. If you think about China, what's China doing? China is clearly trying to muscle in. There's no question about that. Their stated ambition is to displace the US dollar in the Asian region. That's what they've said. Policy. That's their policy, right? How are they doing that? They're opening up their bond market to foreign money. They're creating a digital yuan. I mean, all good things to do. They're basically trying to create a trade credit market in yuan. They created swap lines with regional central banks. They will ultimately redenominate more trade. But the real question is, will Chinese banks lend to foreigners in yuan in the same way as US banks lend in dollars? Are they going to be as keen to do that? Will they discriminate? We don't know. It's not such a transparent system. And more particularly, what will happen in a crisis? Will the People's Bank of China bail out a foreign institution in the way that the Federal Reserve effectively bailed out European banks in the 2008 financial crisis? And I think the answer to that is, well, hey, strictly don't know, but unlikely.
Michael, you said to not focus on trade wars. It gives a whole new meaning to the book that you mentioned. You wrote. It's called Capital Wars. I actually have this here. I want to give you a shout out, Michael, because the name of my podcast, Forward Guidance, I actually got from your book. I knew in the index of your book, I would find all sorts of erudite financial terms, and I did. I found Forward Guidance, and that's the name of my podcast. So thank you for that. I want to ask you when you say what's the Russia can't do a commodity based reserve system. It can't do rubles. It has to rely on the dollar. But what if, as happened, the U.S. financial system shut Russia out and hundreds of billions of dollars that Russia thought it had, it didn't have. It sort of, canceled the money as if this sort of, they turned the computer screen off for the Russian central bank. Isn't that such a nightmarish possibility that, if China invades Taiwan, God forbid, China does not want that to happen? Isn't that so horrible that it sort of may impel other nations to go away from the dollar?
Well, it may be, but it comes back to this point about, if you're owning a trade surplus, where do you invest? There's got to be somewhere you invest. Now, to return to your example about Russia, the sanctions and taking foreign exchange reserves away, there was an ugly precedent for that. And that is World War II with what happened to Japan. Okay. And one of the reasons, allegedly, I mean, I'm not a historian, but I read history, why Pearl Harbor happened was that the Japanese bank accounts in the US were frozen because Japan was threatening to invade Indonesia to get their oil or get their resources. And so the US froze Japanese bank accounts in the US, which prevented Japan buying oil from the US, and the US was a major supplier of oil to Japan. Now, Japan did not have nuclear weapons, we know, right? Russia does have. This becomes a very, very dangerous situation when you're playing with these high stakes. And that's what we need to be very, very, very careful about. And, who knows, how this war will unfold, what will happen. But if the US is genuine, which it seems to be doing, saying, we can sequestrate these assets, then there is clearly an issue. But I think we need to get a resolution pretty quickly as to, what the integrity of people's holdings of financial assets happen to be.
What do you make of foreign appetite for treasuries? I know last year the demand for U.S. treasuries was very high, partly due to interest rate differentials. Do you think that will continue to be the case?
Well, I think the answer is that, to begin at the beginning, what you've got to say is, what's happened in the last 10 years? And what's happened in the last 10 years is there's been a perfect storm for the US dollar in terms of capital flows, okay? You've had, number one, the Basel III bank regulations and insurance regulations, or parallel insurance regulations, which basically forced finance institutions to buy more safe assets. The readily available safe asset, the blue chip, pristine collateral is the US 10-year Treasury note, or 5-year, or essentially the US Treasury note. That's what was bought in size by foreign institutions. Secondly, you had the Eurozone banking crisis, which was, such a shambles that a lot of foreign governments and institutions just shunned the euro and put their money in dollars instead. And then you had the Chinese temporary relaxation of capital controls around 2015, 2016, which led to a flood of Chinese flight capital leaving China and going into US-based assets. And that door was hastily closed. So a lot of money has gone into US assets. And then you've got the latest COVID-19 and the Ukraine invasion. All these things are further boosts to the value of the dollar or the attractiveness of the dollar. But what goes up comes down. And that's the starting point you've got to think about. Can you get a perfect storm in the same way that you've had for the last decade? And we're starting from a situation where the real value of the dollar is trading well above its normal trend. So cyclically, the dollar looks expensive. Doesn't mean to say it won't go up. And clearly, the value of the dollar is not necessarily the same thing as the use of the dollar. What about the fixed income markets? In that environment, I would suspect the fixed income will outperform significantly. The Fed will have to come back and repair the system. Fixed income markets will rally. I would suspect that my estimate has been, although it's been broken through, I thought you'd see a ceiling on the 10-year yield around about 2.5%. We've clearly broken that with 2.8. Maybe that's an overshoot. Hopefully it's an overshoot. But I think that we'll trade through 2%. Yields dropping over the course of the next 18 months. So I'd be optimistic on fixed income. I think fixed income are becoming a more attractive vehicle anyway, simply because of the carry you've got there. In terms of the dollar, I still think in the short term the dollar goes up, although I reserve that judgment over the medium term. And I think the dollar may come under some pressure, but that's probably too far out for us to think about. And in terms of sort of the key point, which is really inflation, and should we hold equities long term? I think I'd say this is that what really matters for the valuation of the equity market is the yield curve, the level of the yield curve, in other words. And one of the things to think about is which regime are we in? Are we in a sort of the average post World War II regime where you had yields sort of centered around 5 to 6%? Are we in a 1976 to 82, you might argue pre-Volcker period for the US where yields at the longer end were nearer 10%? Or are we in this sort of framework that we've had for the last decade or so after the GFC, where yields have been beaten down to levels probably averaging nearer 2% at the longer end, or even lower, but let's say averaging 2%. And I still think we're nearer the latter than any of the two former cases. And in that basis, you would expect to see multiples on the S&P, fair value multiples, over 20 times. I mean, somewhere between, let's say, 22, 20, 25 times for the market overall, the overall market index. Now, that's a medium term. I stress that's a medium term suggestion. And that's saying with interest rates and inflation low, and the reason we say that inflation is low is demographics. The world is going through a demographic revolution, but it's a negative one. The number of young workers coming on stream is falling off a cliff, as we know. The population is aging, but the key thing for inflation is that younger workers are just not coming through. And that typically, in the history of the US and the history of Japan, the history of China, was always meant low inflation when there's fewer young workers. So that's what I would be basing those assumptions on. If we're wrong, and you get inflation, what's the best hedge against inflation? Real estate. It always is.
Michael, what do you think the yield curve will look like over the next 12 to 18 months as, if your model holds, we go from the beginning of the turbulence phase to the middle and to the end? I've heard that actually right before a recession, the yield curve actually steepens because short-term yields fall. Is that what you expect?
Yeah, I mean, that's what the diagrams that we were looking at earlier on pretty much say. You should expect the yield curve to steepen just prior to a recession for all those good reasons that you cite. Short rates may begin to come down at that stage. So that's entirely plausible. But I do think that you're going to get, I mean, that would, by the way, that would still mean, even if short rates come down, but long rates come down, but by less. Okay, so you're looking at a bullish steepening for the long end of the market. That's how we would see it. But yeah, no, I think that we're in for a tough 12 months. I think the Fed is giving us a spoonful or two of medicine, and we've got to, as investors, swallow that hard, and that's the cost of getting inflation wrong. But the system is so fragile. The financial system is so fragile with all this debt out there weighing down on us. Remember, it's a refinancing system. That will break the refinancing mechanism, and it will cause the monetary authority to come back because they ultimately have to protect the system.
Wow. Michael, it's been fantastic having you on Forward Guides. My final question for you is, earlier I asked you, do you think the Federal Reserve will be able to get to that 3.2% terminal rate the market is pricing in? You said no. What do you think, how far do you think the Federal Reserve will be able to reduce its balance sheet? You said the anticipated number is $2 trillion. Do you think they'll get there? Do you think it's 1.5, or do you think that they won't even get close?
Well, I think the lesson to think about in all this is to go back to the 19th century in Britain. Britain's always a very good historical textbook to look at, and it had a well-developed financial system before the US. The US has carried that mantle on forward, as we know. If you look at the UK financial markets in the mid-19th century, so the time of Charles Dickens, etc., what you got there was a period where there were big shadow banks, okay? The money market was very important, and there were lots of crises, if you like, along the lines that we've seen in the last decade or so. It was very common. And what did the Bank of England do in that instance, or in those instances? The policy rule was devised by somebody called Walter Bagehot, author of a book called Lombard Street. Jim Grant in the US has written a biography pretty recently of Bagehot, and idolizes him, I believe, as a very sensible banker or doyen of the banking industry. And basically, what was Bagehot's rule? He said, what you must do as a central bank is to lend freely against good collateral at a high rate of interest. And what are our policymakers doing now? They're lending at a low rate of interest, or they're not lending at a low rate of interest. They're not lending freely, but at a low rate of interest against wobbly collateral. So everything they've got is wrong. And we need to move more to the Bagehot type model, which is basically thinking about what the balance sheet really means. And I would not use the balance sheet as an aggressive tool of monetary tightening, because I think it's very, very dangerous in this context of a refinancing-based market. That's what history taught scholars in the UK, and that's what I think we're going to learn looking forward in our developed Western financial systems.
Fascinating. Well, Michael, thank you so much for coming on Forward Guidance. Viewers can follow you on Twitter at CrossBorderCap. And I definitely recommend your book, Capital Wars. Learned a lot from that. Michael, can you just tell people about cross-border capital and how you don't just do research, you also, I believe, have a series of funds, right?
Yeah, exactly. We manage money. We manage a lot of fixed income money and equity. You have a global equity fund. The equity fund is what is called a UCITS fund, so that's available to sell to European investors. US investors can buy that, but it's it's a European entity, but it's still available to buy. And we manage fixed income money mainly through managed accounts for institutions worldwide. So we've got a money management side, and we have a research business. There is a separation by a wall. Can I call it a Chinese wall? But that's what the term is. And the two operations are separated. I run the research side of the business. Others more competent than me run the asset management business. But the overall company is Cross-Border Capital.
Great. Well, Michael Howell, thank you so much.
Pleasure, Jay. Great pleasure to be on. Thank you.